Following the Swiss president's failure to reduce tariffs on her country after a visit to Washington earlier this week, the Financial Times is reporting that the U.S. has imposed tariffs on imports of 1 kilo gold bars, dealing a further blow to Switzerland, which is the biggest player in gold refining.
In early August 2025, Washington sent a jolt through the global markets. President Donald Trump's administration confirmed a 39% tariff on imported gold bars, hitting Switzerland, the world's largest gold refining hub, head-on. It wasn't just a blow to a small European country's exports. It was a message. No commodity, however entrenched in global trade, is beyond the reach of Trump's tariff playbook. For Canada, watching from across the border, this was a clear warning. If gold can be pulled into the fight, so can other high-value sectors.
The only thing I can tell you from a European perspective right now is that all shipments are on hold. So basically, there's no trading of gold bars between the Atlantic.
Until the first week of August, traders believed bullion would be spared. Gold bars in the 400-ounce form for central banks, the 100-ounce size traded on COMEX, and the 1-kilogram standard used in Asia were assumed to be outside the scope of tariffs. That changed when a Swiss refiner received a formal letter from U.S. Customs confirming that under tariff code 7108-13550, these bars would face the full 39% duty. The immediate impact was severe. Gold shipments between the U.S. and Europe halted overnight. U.S. gold prices climbed above European levels, opening an arbitrage gap. According to U.S. trade data, imports had surged earlier in 2025. 43 metric tons in January alone, nearly double the average monthly U.S. refining output of 22 tons, as buyers tried to front-load shipments before any policy change. Now, those stockpiles are all that's left to bridge the supply gap. For the global gold market, this was more than a price shift. It was a sudden rupture in the supply chain. For Canada, the lesson is straightforward. Gold may not be a major export to the U.S., but the same logic could apply to Canadian strategic minerals, energy products, or even high-end manufacturing. Ottawa knows that even sectors long considered safe under USMCA can be targeted. The gold shock proved how quickly decades-old trade flows can be disrupted by a single enforcement letter. And with Trump's focus on bilateral trade imbalances, Canada's own surpluses in certain commodities could attract the same kind of attention Switzerland just received.
We have a lot to do in this country. We have a lot positive to do in this country, building this country in a way, building one Canadian economy.
I have all the confidence in the world in the Prime Minister. Donald Trump is very, very hard to deal with just because it's so fluid.
This is why Prime Minister Mark Carney's approach carries even more weight in the current climate. While Ford hits back publicly with numbers, Carney is quietly keeping negotiation channels open, even as Canada faces the 35% rate. He is deepening trade cooperation with Mexico, expanding links with the EU, and safeguarding domestic industries against sudden U.S. policy shifts. Canada's leverage lies in what the U.S. needs: strategic minerals, energy, and integrated automotive supply chains. The gold tariff episode only reinforces Ottawa's push to diversify export destinations and prepare contingency plans. From steel and aluminum to copper, and now gold, Trump is targeting sectors where the U.S. can exert maximum short-term leverage. The element of surprise keeps opponents off balance. It's a tactic designed to push trade partners toward concessions before they can rally a coordinated response. But with Canada, the strategy has met resistance. Carney and Ford are aligned in rejecting a bad deal and in showing that Canada will not simply absorb U.S. pressure without a counterplan. For Canada, the gold tariff is more than a dispute with Switzerland. It's a warning shot. Ottawa is combining public pushback with measured diplomacy, signaling it won't be outmaneuvered. The contest is no longer about who can raise tariffs higher, but about who can adapt faster to the shocks still to come.
You got some big name retailers, Walmart, Best Buy. You've also got companies that make everything from the shampoo brands that Americans use on their hair down to the shoe brands. Little by little, the costs of President Donald Trump's tariffs are starting to show here in the U.S.
When President Trump expanded tariffs on over 70 countries on August 1st, the goal was clear: bring jobs back, secure leverage, and force new trade deals. But within just days, the consequences are being felt, not in Beijing or Ottawa first, but in Detroit, Dallas, and the daily lives of American families.
One Detroit auto supplier says he's going to have to lay off employees and close a warehouse because of the president's tariffs.
Went to India to procure products from there, trying to save our consumers money. And now India is hit with tariffs. So everywhere we turn, we're starting to see more and more roadblocks. So it's been quite discouraging.
Major U.S. companies are sounding the alarm. In the second quarter alone, General Motors reported $1.1 billion in tariff-related losses. Ford followed with $800 million. Stanley Black & Decker, a key name in American manufacturing, projects an $800 million hit for the year. Apple, anticipating the impact, has already budgeted $1.1 billion in tariff costs for this quarter. These aren't isolated cases. They represent a broader trend across sectors. Retailers like Walmart and Best Buy have begun passing costs onto consumers. Items as simple as shampoo and shoes now carry silent surcharges. And it's not just speculation. Reuters has tracked explicit price hikes tied directly to tariff pressure. Even the morning cup of coffee might not be spared. The U.S. imports roughly a third of its coffee from Brazil, a country now hit with new tariffs. Economists warn that this could be the moment when the American public truly starts to feel the pinch.
We're seeing kind of these sectoral hits and the impacts of tariffs really showing up in places like cars, vehicle parts, and energy. But energy dropped almost 20% in Q2. Obviously, that's going to be hard hit in Alberta as well as the rest of the country.
North of the border, Canada was hit with a 35% tariff starting August 1st, targeting goods not covered by the USMCA, including steel, aluminum, softwood lumber, and many auto parts. The impact is significant. In the second quarter of 2025, Statistics Canada reported a 13% drop in total exports, with energy exports down nearly 20%. This downturn hits Alberta hardest. Auto parts and consumer goods were also among the steepest declines. But rather than strike back with emotion, Prime Minister Mark Carney is opting for a different approach. Not retaliation, but repositioning. Canada isn't just reacting, it's adapting.
Now, Canada is looking to boost trade with its other North American trading partner, Mexico, as both countries try to work out a trade agreement with a volatile United States under President Donald Trump.
This week, Canada's Finance Minister, François-Philippe Champagne, and Foreign Minister Anita Anon traveled to Mexico City for high-level meetings. Their agenda: reinforce trade ties and reset diplomatic relations with Mexican President Claudia Sheinbaum. It's a calculated shift. Earlier this year, when some Canadian leaders suggested cutting Mexico out of the USMCA, tensions spiked. Now, the goal is realignment. With the 2026 USMCA review approaching, both nations recognize the value of mutual support, especially with Trump favoring bilateral deals. Notably, Trump granted Mexico a 90-day delay on additional tariffs. Canada received no such extension. This disparity has fueled Ottawa's urgency to solidify Mexico as a regional partner. In 2024, Mexico accounted for only 1% of Canadian exports, but officials see room to grow. Trump's approach is blunt force: raise tariffs, pressure partners, and count on American resilience. But the economic blowback is now quantifiable. In just 4 months, the U.S. manufacturing sector has lost between 30,000 to 40,000 jobs, according to U.S. labor data. Carney, by contrast, is choosing strategy over spectacle. His government is investing in trade diversification, protecting vulnerable sectors, and leveraging long-term relationships, rather than chasing short-term wins. It's a striking contrast. One leader fuels instability to force deals, while the other builds resilience to navigate uncertainty. From coffee beans to car parts, Americans are beginning to see the cost of tariff politics play out in real life. What started as a foreign policy tool is now cutting into corporate earnings, family budgets, and job stability. Trump's trade war may have aimed to punish competitors, but today, the collateral damage is accumulating at home. Meanwhile, Canada isn't waiting for Washington's mood to shift. It's building new bridges, and that quiet shift may turn out to be its strongest response yet.
We'll be putting a initially small tariff on pharmaceuticals, but in 1 year, 1.5 years maximum, it's going to go to 150%, and then it's going to go to 250%, because we want pharmaceuticals made in our country.
President Trump has launched his most aggressive trade move yet, this time targeting pharmaceuticals. He's announced a phased tariff plan, starting with a small rate now, rising to 150% in a year, and potentially hitting 250%. The goal, he says, is to force drug companies to bring manufacturing back to the United States. At first glance, this sounds like a nationalist push for health security. But the list of countries affected goes far beyond any single target. The European Union, for instance, has already seen a 15% tariff applied to its pharmaceutical exports to the US. India, a major supplier of generic drugs and active pharmaceutical ingredients, is also in the crosshairs, especially as it continues buying oil from Russia, drawing additional tariff threats. And then there's Canada. While not explicitly named in the initial rounds, it's deeply embedded in the pharmaceutical supply chain with the US and is about to feel the pressure in other ways.
I was going to say, for Canadians, what the issue becomes is that our sticker price may have to come up, because if they're going to start matching up against prices in the US, we're going to be one of the countries that are pinpointed.
For Canada, the blow doesn't come directly from new tariffs, but from pricing policy. Trump's administration has demanded that US pharmaceutical companies implement a most favored nation pricing rule. That means the US should never pay more for medicine than any other country, adjusted for GDP. Canada, where drug prices are on average 50% lower than in the US for new treatments, becomes an immediate target. If drug makers comply, they'll need to raise Canadian prices to keep US prices low. This isn't just about economics, it's about access. Higher sticker prices in Canada could strain provincial budgets and delay the rollout of new medications. The damage doesn't stop there. Canada exports billions of dollars worth of generic drugs to the US while importing branded drugs in return. Politicizing that supply relationship risks delays, shortages, and a chilling effect on innovation, especially for a country already dealing with periodic medicine shortages.
And it's important to note that right now there aren't any blanket U.S. tariffs on pharmaceuticals. As part of that European Union-United States trade deal last week, there was a 15%, and that is already a pretty dramatic increase from the 0% that it was before.
The situation is equally fragile with the European Union. Just weeks after the US and EU announced a framework trade agreement in July, featuring hundreds of billions in planned investment and energy purchases, Trump's administration slapped a 15% tariff on EU pharmaceutical imports. This came despite expectations of tariff stability under the New Deal. That tariff hike didn't just increase costs, it undermined trust. For EU negotiators, it raised the question: what's the point of a framework if it's violated before it's finalized? With EU retaliatory tariffs postponed by 6 months, according to CBS, the clock is ticking. If Trump moves further, the fragile agreement could collapse, adding uncertainty to global pharmaceutical flows already under stress.
Because that was an executive order to bring drug prices down, but then this tariff proposal would, of course, likely bring drug prices up. So it's really going to depend on what these different drug companies do. Do they absorb that tariff? That's going to be a very, very big tariff to absorb. Or do they pass that on to consumers and make it more expensive?
Trump insists these tariffs will force companies to bring factories home. But building pharmaceutical facilities isn't like setting up a warehouse. It takes years, enormous capital, and FDA approvals. Industry giants like Eli Lilly and Johnson & Johnson have announced U.S. investments, but they won't offset short-term disruptions. In the meantime, costs will likely rise. Companies may pass tariffs on to consumers, whether through higher co-pays, insurance premiums, or retail prices. The same executive order meant to lower drug prices might end up raising them. And the global supply chain? It's not ready for this kind of shock. APIs from India, advanced therapies from Europe, and finished goods moving through Canada all risk being delayed or diverted, potentially affecting availability across the board. This may be the boldest move of Trump's second term, but it's also the most dangerous. In trying to control global drug pricing and force reshoring, he's putting both trade relationships and patient access on the line. Because if Trump doesn't recalibrate, the cost of these tariffs might not just be economic. It could be medical,